pop a top edge into our screen. So let's just pop that in. Now, obviously, you can take my word for it that that was a top edge. You can see the yellow line anyway. It's not going to make any difference. So we can recognize that we've got a top edge in the background here. And we're now looking at this as the top edge that we're talking about in this tweet. $81.40 to $81.50, right? So we've now got that trade keyed in and we're now looking, okay? So what are we looking for? We're looking for the story in terms of the order flow. The story in terms of the order flow is obviously this storyline here, isn't it? Look, the tick delta goes down. The book goes very offered. So in other words, the book and the tick delta are agreeing with each other. That gives you a lot of confidence that that trade is the trade. And at the same time, look at the volume delta. You see the volume delta surging? Is that not the deal? What do you think? Is that not the deal in terms of perfect order flow? You can see the time well after the tweet. So you're now looking at this and saying we were way ahead of the curve here. We were now talking about the top line. We were talking about 8140 bid. So we were looking at that 8140 bid price area. And we were looking up towards the 8150. And with the rally in bonds leading the process, which obviously opened the door to that spread trade, that hedge spread trade. Now, on the downside, it's only 10 ticks and a stop at break even. But that's all there ever will be. You don't know after you've put that trade in what's going to happen next. The sellers might pour in like they did in the bond. There might be too many sellers. The market maker might get too long and they have to take the price up to just balance their books. So in the last bond trade, it was a great bond trade, but we still only made literally 2 or 3 ticks profit on it. Well, in that trade, we only made 10 ticks profit on it, but we're still making profit. Now, I thought this oil would have done better because, well, you can see why. I thought this oil would have done a lot better because obviously you can see that the tick is a lot more bearish than the volume delta is. And my feeling was that this was going to do a lot better than it did. I mean, you've got trapped buyers in here, and then these buyers still not turning around. I thought there was a lot more to this sell than there was obviously developing. Now, one of the challenges that we had on this sell was the demand in the short term showed back up again. So we got an edge, but with the demand showing back up on oil again, that edge was kind of taken off us, wasn't it? It was taken off us almost the second we got into the trade. And that's why it was very easy to get away from this trade. So when we took the trade originally, we had a divergence creeping in from this prior here. We had taken in a little divergence into that edge. If you were watching it in real time, you'd have seen it. The bond was giving us a strong story, but the edge didn't develop. Look, within 5-10 minutes, the supply had changed into that short-term demand. And that short-term demand had just meant that as soon as we came into this bottom edge here, people were willing to buy it back in again against that story. So it just meant that we were able to pick up our 10 ticks, walk away. And these are the things we can't legislate for. We don't know what's going to happen. We don't know if the demand is going to stay in place. We don't know if it's going to sell off. We don't know if the sellers are going to pour in behind the short. We don't know if the buyers are going to pour in behind the short. We don't know. All we can do is react to what we then see happening at that stage. So we can never do. That's all any trader can ever do. There is no other way of dealing. We react to what happens next. We put our best foot forward. We play the probabilities. We make the monies. And then we get out when the change takes place. We get out when the deal takes place. I was watching a little, I was watching a video. It wasn't a video. It was an interview. I was watching an interview with some options guys. Now, I've never been an options trader. I've never been involved, in my professional life as an options trader. So options isn't my forte, and I've obviously made sure that everybody knows that when we've talked about options, it's not my bag. But obviously, I know enough about options, way more than the vast majority of traders know about options, because they're not options guys either. But at least I've been involved in options, but as I said, not as a primary source of trading. But one of the things that this chap was talking about was a classic example of commercial options trading. He was talking about, and it's a successful group. Hold on a second, I'll just post that oil whales to remember to do so. That short selling bonds is doing well, Reeve. I don't know what price you got, but I came back in at fives. Reeve, you might notice Reeve's comment. Reeve was right on the numbers there. We don't want to miss this trade, right? So we had to make a decision to cross. Difficult decision, but we had to make the decision to cross, because if we were going to wait, we were going to wait a long time, weren't we? Let me just post that as well. So we've been obviously, for anybody that's just joined us, we've been working short selling bonds, by the way. If anybody's just joined us, we actually talked about this very trade here. And we took the trade on the books at sixes after an aggressive buyer showed up into sevens. So we took the trade on at sixes and we got a reasonable response. Now, like Reeve mentioned, if you look back on the commentary, you'll see that at 12:58, Reeve clearly stated you don't want to miss the 1 o'clock trade. Now, that's really important, and I love the fact that Reeve actually made mention of that, because it reminds people that we don't want to hang around if we're not going to get the price. We've got to make a decision now. I'm not saying that decision was easy. I'm not saying the decision was easy from an order flow point of view, because there was a lot of sellers in there, and they were selling at fives and sixes, right? So you were kind of starting to join quite a busy queue, but at least it was not the bottom edge price. Now, why did we need to cross the spreads? Well, look at what was happening at 1 o'clock. Look at the curve at 1 o'clock. So if I'm able to get fives or sixes, I think I've still got 4 or 5 ticks on this trade anyway. Agreed? Do you all agree with that? Is that visible? I think I've got about 4 or 5 ticks on this trade. So obviously selling in this occasion at fives, never get filled at sixes, to me was exactly what Reeve was talking about. We needed to cross the spreads to get the business done, because if we sat there waiting for the price to come to us on that occasion, it was never going to happen. There just wasn't the desire or the ability to get the price up anymore. So we had to make the decision. And if that's one that you passed on, that's just one of those things. It's just one of those unfortunate occasions, wasn't it? So well done if you took the short. Stops worst case at break evens. I like it. I like it a little bit. And considering this was a live trade call in the room, I think we've done pretty good for ourselves, making a few $100 coming off those little cheeky rotations. So we like that. We like it. We like it a little bit. Not a lot. We like it a little bit. So welcome in, guys. We're obviously running through the welcome in part of the day. We've had a lot of data out this morning to work our way through this morning. So it's Monday, 31st of July, last day of the month. So watch that 3 o'clock rebalancing that kicks in. Remember, 3 o'clock rebalancing starts to kick in for the 4 o'clock London fix. And we obviously have a few ideas. The concepts of rebalancing can be looked at. You can obviously do some research by looking for rebalancing information from some of the big major banks. And you can obviously look through some of the tweets, see what people are saying about rebalancing, about who's going to be the net beneficiary of a rebalancing effort. Anyway, let's get through the numbers quickly. In the overnight session, Japanese retail sales actually improved quite significantly, 5.9 against an expectation of 5.4. As we move into the overnight session, Chinese manufacturing was better than expected, but still in contraction at 49.3. 48.9 was forecast. Non-manufacturing PMIs came in at 51.5, softer than the 52.9. So a little bit disappointing on the PMIs. There's obviously a lot of chatter in the markets about Chinese stimulus, which is one of the upsides on equities, of course. Anytime the Chinese add money into the system, just like any other central bank, the equity market likes that storyline, and we see a good upside drift, or sometimes a drive higher. Japanese consumer confidence numbers 37.1. Forecast was 36.1. So another decent number from the Japanese consumer side. Retail sales popping, consumer confidence popping. That's not a bad sign. However, housing starts declined significantly to 4.8% down. Forecast was for a drop of 0.4. Moving into the European session, UK money supply came in at minus 0.1 contraction. Mortgage approvals, however, were up 55,000 from a forecast of 49,000, which is a bit of a surprise because obviously, with interest rates and with mortgages, there was always a suggestion that perhaps the housing market might start dropping off a little bit. But certainly, according to this month's mortgage approvals number, no such thing is happening in the UK for the time being anyway. Net lending was up significantly, 1.3 billion to 1.8. Net lending isn't just net lending to cover the cost of cover the cost of living. Well, although there's been some reports in some UK press this weekend that people are borrowing to pay their normal costs. Obviously, that could be part of that storyline, but obviously, usually you see net lending increasing. It normally goes on bigger assets like cars, houses, etc. Moving into the European numbers, the CPI flash came in line with expectations at 5.3. The forecast was for 5.3, as it normally is. Core numbers were a little bit hotter. That was a little bit of a pity for the core numbers overall, 5.5 against 5.4, but still in line with prior of 5.5. But still, we want to see those inflation numbers drifting down rather than up. Equities have done a very good job so far of pushing those aside and still getting their upside hold. The hold above 4,600 could be significant. Obviously, the more it holds and stays above here, the more time it spends above here, the more the option values get pressed into that area. That means that there might be some opportunities to start making gains above, and we'll get a better read of the underside because obviously all the deltas, the key at the money strikes, will all start focusing where? 46 handle, right? So if the key money strikes all are at 46 handle, is that below or above the current price? It's above. So if all the key strikes are 46 handle, where is all the hedging? On the buy side of the market, right? So all the hedging is on the buy side of the market. So only if the price then drops below the 46 handle does the market then become bearish. So it gives a level of support in there to allow you to consider the upside on equities could build the next case of higher demand prices. So when we see that happening, it's a good sign at this point. It's not a brilliant sign, but it's a good sign. Into the US session this afternoon, 245 Chicago PMIs is the first numbers out. So obviously we've got the 2 o'clock NYMEX, COMEX kicking into life. We've then got the 230 for the cash market open. And of course, then we've got the 245 Chicago PMIs expected to improve to 43.3 from 41.5, still in contraction territory, but 43.3 improvement from 41.5. I don't think that's going to give us any real concerns in terms of equities because it is still in contraction. Even if we get a hot number there, I don't think it's going to have a big negative impact on equities because we are still below that 50 threshold for expansion. And that takes us to the end of the day, of course, nothing else. Tomorrow, we start getting some cash rates from the central banks. We've got a 25-point hike by the Australians. Interesting to see if they put the Australian rate on hold following that numbers. Some interesting numbers out of China tomorrow as well. Asian manufacturing PMIs. Contraction or expansion? That's the question, because it's right on the 50. Also tomorrow, we've got a lot of PMIs, manufacturing PMIs out of Europe, the UK, and of course the US, with the ISM manufacturing and final manufacturing PMIs out of the US. JOLTS job openings finishes off the US day tomorrow. So a lot of manufacturing PMIs tomorrow, Australian cash rate, Chinese manufacturing PMIs in the overnight session. So plenty for us to be getting busy with tomorrow. Those manufacturing PMIs showing just the depth of strength of the economy, to see if we can start moving those, because most of them are below that 50. So if they start creeping towards the 50, it's not a bad sign, and it's not going to be bad for equities because it is still in contraction territory. So even if we do get hot numbers on these prints, so long as they're mega hot, but so long as we get good numbers, that's going to be good for growth. It's going to be good for earnings, but it's still not expansionary, and therefore it's not going to be sensitive to the rates narrative. And that's the good sign about having good numbers from a low print price. It's not inflationary. So that's what we're looking for. That's what we're hoping to see. And obviously we'll be watching that tomorrow. But today, let's get these numbers out of the way. Not an awful lot, as I said. Chicago PMIs this afternoon, 43.3, 41.5 prior. And that's all we've got. In terms of this morning, we talked about implied volatilities on the pre-market. There was one possible trade if you wanted to play short, if you have the ability to play short. We had Sophie on a bear skew last night. Sophie on a bear skew last night for pre-market. There it is there, pre-market with implied volatilities. I mentioned to the guys that we have high implied volatility because every earnings report has an implied volatility attached to it, of course. But some of them have 10% implied volatility. Some of them have 20% implied volatilities. I want to trade the high implieds. It's as simple as that. I want to trade into the ones that are going to give us a bang for our buck. And I want to see if those implies are built around the put options or the call options, because that gives us a skew. And if that gives us a skew, it gives us a storyline. So the only storyline in town was this Sophie bear skew. And obviously you might be saying, but what about the IMGN bull skew? Well, there's no volume on it this morning. There was no trade opportunities. We actually tried to get it, but we never got filled on it. It still made, believe it or not, the IMGN skew actually still made a 10% gain on the upside. So these are all going to be about 10% implieds for one day. 10.4 means we're targeting about 9.4. So obviously selling 10.4 at the top edge here. We're targeting 9.4 at the bottom edge here. That's exactly where the price went to. The dealers nearly always get this right. That's why most of these trades end up around about 7, 8, 9, 10, 11, 12, 13, 14, 15% gains on these types of trades. Because if you get the implied right in terms of direction, the percentage will probably be right because the dealers won't apply liquidity until the 10% skew is used. You understand? So if you looked at this as a 10% implied and it's $10.40, if it was a balanced skew, where are the offers? Well, the dealer would obviously come in and say, okay, well, I'm going to offer $11.40, right? So where are the dealers going to bid? They're going to bid $9.40, right? So it's not that difficult to work out what the trade's going to be in terms of where the trade is going to go to following the earnings report. It's going to go that 10% implied range. So if the earnings has a 10% implied volatility, that's what it means. The price has a 10% implied volatility. If I can then try and figure out whether it's got a bullish or a bearish skew, I can make a far better job of coming up with that information, coming up with that idea. And obviously the skew from the previous day here on Sophie was bearish, and that meant that I had a fair idea this morning in the London session when the market was drifting higher. I had a fair idea that this is pure manipulation to try and get short. And obviously on low volumes, a pure manipulation to try and get short, as you know, it normally takes place. So driving the price higher into those manipulations for the short sell, and then the 10% implied gives me $1 profit out of a $10 stock. Nice on the short sell, if you can get short sells from your broker, of course. So that was wonderful. I like that a lot. Whether you did or not depends upon whether you were able to take advantage. So welcome in, guys.